Okay, so good morning, everyone. Watching this at a later time or date, it is Monday, February the 26th, 2024. Just want to do a bit of a macro overview and see where we are as we go into a few important things. Okay, guys, so I think the most important thing to understand is that we might be in a bit of a holding pattern for maybe the next 2 or 3 weeks or so. Now, why would that be? Just because I think what we've seen over the last 2 or 3 weeks, we've seen some fairly hot data. We saw a higher than expected CPI. We saw strong labor market metrics. We've seen strong forecasts of GDP, which we spoke about last week. And so what's happening is that that's putting, we also saw strong NVIDIA earnings. So in general, the narrative at the moment, I would say, is that the Fed or the market has priced in a slightly more hawkish forward path of the Fed. But on the other hand, we have a situation where the market believes that the real economy, at least in the US, is pretty strong. So really, the question now is sort of what happens next. And I think really it's very simple. The market is entirely data dependent. I'll get onto that in a second. We're now waiting for, obviously, we have the core PCE. We have 4 very important things. We have the PCE coming up this Thursday. Then next week, we have the employment data. We have non-farm payrolls. In the middle of that, we have ISM manufacturing and services. And then, of course, after that, we have CPI. And of course, the following week, we have the FOMC meeting. So essentially, in the next 3 or 4 weeks, we have, I would say, 4 or 5 key data points. And it's very simple, especially for the bond market and potentially, therefore, for the equity market. Those data points will either give us a clear dovish direction, a hawkish direction, or of course, it could be something in the middle. So I think what that's basically going to say is that I think for the next 2 or 3 weeks, in my personal view, we may get a little bit of range trading, especially in maybe the commodities and the bond space. Equities, it's difficult to know, but it could, there's reasons to think that equities might take a little bit of a pause. But before we do that, I just want to get into a bit more specifically and just review the situation. As we spoke about recently, just keep an eye always on this number here. This is the last summary of economic projections, absolutely fundamental because this is what the market is waiting to understand. As you can see, back in December, just to refresh our memories, we see that the median dot was 4.6%, down from 5.4. Now, what's the implication here? The implication back in December, of course, was that the Fed believed they were signaling to the market 80 basis points difference. Let's call this 3 cuts. Now, really, the issue here is, will this number remain the same? And of course, the other thing to look out for is the longer run. But as we've discussed recently, there's a big chance that the GDP numbers will be revised upwards. Now, if the GDP numbers are or forecasts are revised upwards, real economy data continues to come in strong. We have ISM this week, manufacturing, then ISM services, non-farm payrolls. If all of that stuff continues to come in strong, it almost leaves the Fed with no other choice. I don't want to say no other choice, but there's a relatively good probability that the Fed may revise upwards their GDP projections. And if that is the case, that leads us to the conclusion that it's possible that they may want to take out to remove 1 cut. So rather than this number being 4.6, they may put that up to 4.8 or 4.9. Now, if they do that, what's the implication there? If they do that, the implication is that the dot plot, where is that? Oh, yeah. The dot plot will have to, well, if the dot plot changes, that means that the forward path of interest rates on the front end will probably have to change. So if we go back to the SOFR contracts, and this is a great tool with the CMA, again, what it's showing now. Now, what's interesting is that this was showing 100 basis points of cuts just like a few weeks ago. And as we saw, over the last few days, basically the market has priced out about 60, 70 basis points of cuts over the last, well, since January the 12th. So the first very, very important point, in my opinion, is that the market has not done nothing. The market has actually repriced hawkishly the short-term bond market. So that's the 2-year yield, the SOFR contracts, and to a lesser extent, the long end of the curve over the last 6 weeks or so, since January the 12th was the most dovish point. But still, the market is pricing in 70 basis points. And what I'm trying to say here is that if we take out a cut from, let's say, September, which is the election cycle, getting into the election cycle, and let's say we take out another cut from November, which is right when the elections are, and maybe we put just 2 now. So let's say, for example, if the Fed indicates to us in the upcoming March meeting that they only want to cut, or the dot plot is only 2, suddenly we only have 2 here. You see this? And we still have a few cuts priced in for 2025. But I want you guys to notice here what is fair value. So fair value is essentially the red line here, and predicted is where the market forward pricing is. But if we actually then take out a cut, and this is based on the idea that the Fed, based on inflation remaining a little bit sticky and not going down as fast as necessary, and secondly, the real economy, if we calculate this, we can see, what do we see? We suddenly see that the predicted price has to drop. Okay, so hawkish repricing. And what that means in just simple mechanical mathematical terms is that some of the short-term contracts, the SOFR contracts, which is the 3-month bond, you guys can see here in the September contract, it needs to be repriced by 26 basis points. And you can see, sorry, did I say September? Yeah, September 26 basis points, and December Z4 is 19 basis points. Let's call it 20. So the point here is that at the very front of the curve, just mechanically, we can assume that if the Fed changes the dot plot based on, as I said, inflation not going down more quickly towards target, and based on the real economy, that the very front of the curve will reprice quite dramatically by about maybe 50 ticks, or about 20, 25, 27 basis points. Now that will also put pressure on the front end of the curve a little bit further out, the 2-year. Not as much pressure, because remember, the 2-year at the end of the day is the accumulation, the aggregate of all of the short-term interest rates built up going over 2 years, whereas something like September or December, of course, is only the next 6 or 9 months. So it's a less aggressive. So the point is that this move will not be as aggressive on the 2-year, but nonetheless, that's a real issue. So the thing is that, if we maybe want to look at a chart now, let me just find a chart. I just want to take you guys, let's say, to the December SOFR contract, which is, where is that? Sorry, let me just bring it up. I've got a lot of stuff here. There we go here. Okay, so what you guys can see here, this is the price now for the December, which I think is going to be the key one. And I think basically what we're saying is that we've come, this is the high point for Dove, sort of confidence that the Fed was going to cut interest rates aggressively. As you can see, it's the 12th of January when it was at the high point. This is the FOMC meeting. Subsequent to that, as I was pointing out before, we have come down 60 or 70 basis points. So what I would say is that a lot of the pain at the moment has been built in. And I think the market now is probably just going to range now. There's about a 25 basis point box. What's this level here? About 95.45, 95.48, something like this, up to about here. I think it's going to be difficult over the next, sort of week or 2 or 3. It could push down a little bit more if, for example, the CPI comes in higher than expected, if non-farm payrolls comes in hotter than expected, if the PCE comes in higher than expected, et cetera, et cetera. It could go down a little bit more. But at this point, I think for significant, more hawkish repricing, which would take us down into this kind of zone and higher in the implied yields, I think we actually need to see the summary of economic projections, the famous dot plot, actually revised upwards hawkishly. So that's where we're at the moment. I think this is the trading range for that. Now, if we then go and look at a couple of other charts, I think, what is that telling us? If we look at something like, let's say, the 2-year yield, and we'll focus on bonds just at the beginning, because we have a position on that, and also I just want to explore that. That's going to, push the rest of the market. So let's say, for example, if you look at the 2-year yield, a similar kind of situation here, that again, you see here going out towards middle of December. That's where the FOMC is. Everyone was very happy. The Fed revised their dots lower. Everyone was like, they're going to cut aggressively. Happy days. And then we started to get, that the CPI surprise, and the economic data continued to come in much stronger than expected. And so subsequent to all of that happening, we've seen, very similar to the SOFR contracts, a repricing. Again, similar kind of situation that we've seen about, 50, 60 basis points added onto the yields. Which hasn't been great for our position. We've taken a bit of pain there. But again, we're at now a technical level where the 2-year yield is kind of probably going to stabilize, I would say, over the next, weeks, 2 or 3 weeks. Now, the question is, and again, it's probably going to trade in this trading range here, depending on the data and everything over the next 2 or 3 weeks. So the real question is, well, actually, we'll get to that in a second. If we also look at the 5-year, we can also see a similar kind of situation on the 5-year. I think this little box up here is what I've put on is probably sort of like a bit of a soft cap on the upward yields just for the time being. What is interesting is that today at 11:30, actually just in a few minutes after, like in 10 minutes or so, we get the 2-year auction, and then at 1 p.m. we get the 5-year auction. So today, in the next couple of hours, we get about, I think about $130 billion worth of 2-year and 5-year bonds being sold. So one could also argue that that represents a bit of a risk event. And maybe if those auctions go well, if they're absorbed, you can say that a lot of the concession in the price has already happened, and we might get a bit of a relief rally. So I'm going to be kind of curious to see how that 5-year auction, well, the 2-year auction, but also how the 5-year auction goes at 1 p.m. today, and just to see whether if that's absorbed by the market, we could get a bit of a relief rally, and maybe these yields come down a little bit in the 5, because that could almost be sort of a point of maximum pain in a sense. So we have all the pressure from the Fed speak, and the CPI and the real economy data, and then of course we have all this issuance on the front end of the curve. Okay, so that's for the 2-year. So that's it. But of course, really to make this move higher, we have to see what happens with the dot plot. The other thing as well, though, guys. So therefore, I think the other issue as well is that, let's say, for example, we look at the 10-year. You can see this a similar kind of thing. The 10-year yield has also got to a similar point of sort of, I would say, equilibrium for the time being. A lot of hawkishness, very similar to the 2-year, and the SOFRs, and the 5-year has been priced in. And again, I've got a little bit of a maximum of the yields here. And as you can see, in fact, it hit that technical level, and is over the last 36 hours of trading has kind of come down a little bit. But what's interesting is that in terms of the yield curve, is that we will continue to have for the next year or two, let's say 12, 18, 24 months, significant issuance. And eventually, because the US deficits are not going to be reduced, we're going into an election cycle. We're already in the election cycle. It looks like Trump is going to be the Republican nominee. And of course, we have Biden. Biden is not going to suddenly slash the deficits and stop spending. And we know from Trump's first period in office, 2016 to 2020, that Trump also was fiscally not very prudent. So Trump will probably continue to spend as well. So the point is that from a sort of a slightly zoom out big picture perspective, US deficits are not going away. And therefore, the implication for the bond market is that the US Treasury will continue to issue a huge amount of deficits. And we're now actually issuing more bonds than even during the COVID period. So the point I'm trying to make in simple English, to cut to the chase, is that at the long end of the curve, there should be structural pressure on the long end of the curve. So we have this sort of weird situation, well, not weird, but we have this situation at the moment that really for structurally both ends of the bond curve to rally, we probably need the FOMC to actually start cutting rates. And we know now that that was forecast for maybe March, May, or June. It's now looking more like maybe June, maybe 1 or 2 more in this year. So it's going to be, we're going to have higher rates for longer. So definitely that scenario is being turned over. So in order for the bond market in general, both ends of the curve to rally, we'll probably need the Fed to actually start cutting rates. And also we're going to need inflation, not just to remain at this sticky level, but actually to get down towards the 2%, or maybe even a little bit below it for a significant period of time. So the point is that it's going to be hard for bonds in general to rally, especially because the back end has the pressure of issuance and higher inflation, or let's say sticky inflation and strong economic growth. So that's going to put pressure on the back end of the curve. At the front end of the curve, we have the fact that the Fed is being very patient and is not really helping out by cutting. So both ends of the curve are going to find it difficult to rally. So therefore, I guess the point is that really where the changes are going to be, is going to be in the yield curve itself. So not the bonds just floating up or floating down, but probably the yield curve is the one which is going to react most to incoming data and incoming sort of positioning or policy by the Fed. So let's have a look at the yield curve and just see where we're at. Let's say we look at the classic one, which is obviously the 2s, 10s. Now, what you guys can see here is that, you know, we did have this sort of in rally, we had a bit of a bull flag, it broke out, but subsequent to that now we see that it's given up a lot. And that's just very simply, as we all know, because of, you know, the Fed has been pushing back in reaction to the data and the CPI prints. And so we're now at a situation where the, you know, the twos, tens, it could flatten a little bit more, which is not wonderful for us, but it could flatten a little bit more. But again, the question is, how much more can this flatten? We've taken quite a lot of pain, or the market's taking a lot of pain. So I think, you know, we could get down, let's say, to 47, minus 47, maybe 50 basis points, this kind of zone here. But I do believe at that point, that will represent some kind of floor, because the market ultimately knows that at some point, you know, the Fed probably will want to cut. Now, I had hoped that would be more like in a sort of a 3-month period of, let's say, March to June starting, but it looks like that's being pushed out by 3 months. The other thing to keep in mind is that, let's say, for example, I don't know, we look at the 5s, 10s, for example. No, actually, that's the 10s, 30s. Let's look at the 5s, 30s. Similar kind of situation. It could go down a little bit more, but we have seen a significant flattening over the last you know, 4, 5, 6 weeks. So I think a lot of that repricing is now built into the curve. So let's have a quick look over in Europe and see what's going on in Europe. We actually had Lagarde speaking this morning, but if we actually have a quick look over in Europe, we can also see, let's say, for example, looking at the Schatz, so the 2-year. I'm just going to grab some water here, guys. I do beg your pardon, excuse me. So we can see here that a similar kind of situation. As I was talking about last week, you can see that the 2-year did in fact fill that gap on the yield. And we now have a situation where that also, like the 2-year in the US, is kind of stabilizing. You know, and it's about 50 basis points has also been taken out of that curve. And so probably, again, that's probably going to range maybe between, let's say, you know, 275 and maybe 295, something like in this sort of range for the next couple of weeks. We also see, for example, in the German 5-year yield, maybe we throw on like a fib or something, we can see that, oh, where's my fib? We can see that, you know, that got up to like a sort of a fib level. Oh, let me just put that on. Just have a look here. You see that came back to like a sort of a fib kind of level here. So the point is that all across the developed world, we're getting the yields which have, you know, substantially been repriced. And so really what the market is needing now is more information. Now, in the case of Europe, they've put a lot of emphasis on the wage negotiations, a little bit like the situation over in Japan, where they have wage negotiations coming up in the spring. A similar kind of situation in Europe. And basically what Isabel Schnabel was saying, and Lagarde, both of those influential members of the Governing Council, have been saying that they need to see more information about the direction of wages. And the implication here, at least in the European space with the ECB, is that if the spring wage negotiations are modest and don't show a huge spike upwards in wages, that would give the ECB more confidence to start the cutting cycle. But at this point, it's relatively similar to the Fed in the sense that the market's pricing in the first cut for June. And so I think they're going to move together. But what's kind of going to be interesting there is the question of differentials, which we'll get to in a second. But just before we head off that, just want to have a quick look at the spread. What is interesting, guys, something which has been a strong move lately, just in terms of the European space. Just look at the spread here between the Italian and the German. We can see that the Italian bond has been outperforming the German bonds like a lot, very significantly. And I think the way to explain this is twofold, is to say that first of all, domestically in Italy, there are no particular idiosyncratic political pressures or dramas or crises or anything at the moment. So that from a risk perspective, I think the market is you know, relatively sanguine about the situation in Italy. Everyone seems to be fairly happy with what Meloni's government's doing over there. And simply at this point, I think the market is saying, hey, until we get any kind of bad news out of Italy, let's just go with the carry trade. And essentially at this point, we can see that the Italian bonds, look at the Italian bonds here, they're paying, you know, almost up towards 4%, 3.88%, which is obviously at a premium compared to Germany. And so as long as that carry trade is, you know, there's no risk. I mean, I think the market's just happy to sort of be long of Italy and short of Germany, and picking that up. Now that could change. And by the way, this week, little risk event, the Italian government or the Italian Treasury is issuing a bunch of bonds, what are called BTP Valore, and that's aimed at the retail market, for domestic consumption. If that is not very well absorbed, I think that's on Wednesday or Thursday, that could put some upward pressure on the Italian yields and on the spread. So that's a little micro thing I'm looking out for later this week. But basically at the moment, I just think in terms of trading, what we could be seeing here is, something like if this rallies up towards maybe this kind of level, it could be like a sell again. Or let's say, for example, the Italian bonds get up towards maybe 4%. That also could be an interesting buy for the Italian bonds. So buying on dips. I think that's the interesting thing. The other thing just to think about here, and this is also important for the currencies, is let's have a very quick look over at the differentials between the US and Germany, which I think I have. Where is that? Is it this one? I think it's this one here. Sorry, guys. Yeah. So as you can see, this is the US 2-year versus the German 2-year. Pretty much trading in a range here. I don't think there's anything particular to see here, just because it's in a range. But what could be interesting is that where the market has gone has changed. So let's have a look at the 5-year as well. You see it's also trading pretty much in a range. If you actually look at the economic performance and the growth, the prospects for growth between Europe on one hand and the US on the other hand, I think this could change a little bit. The market, I think, is discounting a little bit too much about European growth. European growth and the economy is definitely not as strong as the US. And I do believe that the Fed will end up cutting, the ECB may end up cutting perhaps before the Fed and maybe even a little bit more aggressively, just because inflation is much more under control, is really trending down towards target in Europe. Also, it looks as though wages, which we just spoke about in the Eurozone, are actually not really spiking upwards. And secondly, just growth indicators in Europe are okay, but there's certainly the real economy data is not as strong in the US. By the way, am I recording this? I'm not sure. Did I actually record this? I hope so. Anyway, so all that to say that when and if the future plays out, I do believe that the US rates have the possibility to go higher comparatively to German rates. And that means the differentials should blow out a little bit in favor of the US. So therefore, I think that, for example, something like the twos, if we look here, I do believe that could go up more in favor of the US rates. So that's something which I'll be looking at, but we'll need a bit more information. And by the way, if that's the case, if we start seeing these differentials going higher, moving higher, especially in the 2s and the 5s, moving up towards here, that in theory should put upward pressure on the US dollar. That should be a negative for the euro. So that's something to keep our eyes out on. So that's where we're at, guys, just in terms of the bond market. So then we get on towards let's have a look at equities. So what's interesting is to say, well, okay, so yields have been going up quite a lot. The idea is that the real economy is strong. The Fed is maybe going to cut less aggressively, and it will take longer for the Fed to actually begin their cutting cycle. So then the question is, well, where are equities? And we all know that the equities have had a big run up. And not only US equities, by the way. If we look at, let's say, a couple of the others, we can see, so for example, let's say over in Europe, we see the Euro stocks at all-time highs here. We can also see the German DAX doing pretty well. We see the Nikkei over in Japan getting back to its, I think, 1989 levels, which has taken them, 30, 40 years, whatever, but, pushing up. So it's not only in the US, China as well, on recent sort of cuts to the loan prime rate, has also doing quite well. And that's something which we probably should be looking at a little bit here. If we look at, let's say, something like the FXI, which is the China large cap, that's starting to show signs of life. As you guys can see here, had a bit of it broke out of this long-term downtrend here and is starting to come back up. Let's just see, at this point, it's a Fibonacci retracement. So what's kind of going to be interesting to me is just to see how this reacts at this 50% Fibonacci retracement. What could be quite interesting is just to see whether it comes off a little bit and let's say it gets bought up, that could be interesting as a trading opportunity to see if it wants to push higher. But at this point, you can say it's just a fib retracement. We don't want to get too excited, but definitely the FX side, the large cap over in China, is something to look at. And what's the macro there? The macro situation there is that the Chinese government over the last 2, 3, 4 weeks has made substantial policy changes. They've been cutting the loan prime rate, so they're really trying to boost the property market. And secondly, they've made it easier or more, it's easier to buy stocks because they've changed the leverage and everything and the margin requirements. So, overall pretty positive. But if we get back towards the US here, we can see that, let's say, for example, just look at the SPX, the cash market here. Obviously, we all know that that's been on a tear. It's been ripping higher for the last, since November. So the question now is, is this just the Magnificent Seven? We know NVIDIA had great earnings last week. The NASDAQ NDX also up. So what's going to go on? Now, it's tricky to kind of predict the future. But so we can look at sort of a few technical things and say, well, I mean, what's interesting, maybe just looking at something like some of the commodities. So if we look at, let's say, like a classic, before I get back to the equities, let's say, for example, we look at DBC, which is a general commodities kind of basket, an ETF. And you can see that it's trading along lows and has certainly been, it's in the doldrums. It's not doing particularly well. And so the question is, well, if the real economy is so great and the global economy is hanging in there, shouldn't the commodity space maybe be showing more signs of life? And it's not. And you look at the industrial metals index, that's pretty weak. Agriculture, the ags are down. We see that oil, had a little bit of a bounce, but basically, let me just double check. As I said, that it's probably ripping today. But you can see that oil, it's doing okay, but it's not exactly ripping higher. And so the question is, should the fact that the commodities is a little, I'm not going to say super weak, but a little depressed, is that trying to tell us that in the equity space that the global economy, maybe the US economy, is not that good? I mean, I'm just posing the question there, because certainly the equities are doing very, very well. The other thing as well, just in terms of very short-term stuff, is that we had the end of month, obviously finishing this Thursday. And, as you guys know, that just from a corporate point of view, the end of month is actually a couple of days before that. So basically tomorrow. And so just in terms of rebalancing, could we see a situation whereby the equities, there's a bit of a flow out of equities into the bond market? Could that give the bond market after the auctions today and tomorrow a little bit of a boost? And could we see a little bit of selling just in the equity market, just to rebalance portfolios like the 60-40? That's possible. So there could be a little bit of downward pressure on the equities. We're not seeing a huge amount today. But the other thing as well, guys, just technically, which I looked at a couple of things over the weekend, sort of interesting. If we look at, let's say, like the Bollinger Bands, and I want to put this on, you see it's really at the top of the Bollinger Bands. And if you look at, something like on the monthlies, and just to zoom out and have a little bit of perspective here. If you look at, let's say, the cash SPX, you can see it's really very, very high. It's significantly above the monthly Bollinger Bands. And this could be important just because as I said, we're about to have the end of month. And as you can see, that anytime it kind of closes above the monthly Bollinger Bands, in general, what happens, you see the monthly Bollinger Band closes above or below. In general, there is a little bit of mean reversion. I don't want to predict the future based on, technical analysis here, but I'm saying this is significantly overextended. And just historically, when we do have this, deep overextension in the monthly Bollinger Bands, often what we do see is just a little bit of a pullback. I'm not saying it's going to collapse. We'll just go back to the daily chart here. But the point is saying that we are due for a pullback from a technical perspective. And I just wonder that, as the yields push higher, as maybe there's a little bit of nerves going into these, the PCE, the CPI, the Fed, and the economic data. Is there a moment we've had NVIDIA, maybe just for the equity market to pull back a bit? Maybe like 100 or 200 points, something like that. Maybe we'll get like a 2 or 3, 4% drop. So I'm just having a look here, just at some of the levels I was looking at. It would not surprise me. This level here is quite interesting, like on the cash SPX, 5,020, 5,030. Personally, I think that looks like a sort of an interesting level. And not unreasonable for the equities to pull back. And again, I'm not saying equities will be collapsing for the next 6 months. I'm simply saying that all technical indicators are massively overbought, and we know they can continue. But just going into the several risk events over the next 2 or 3 weeks, a pullback of to 520, 530. It's only 1 or 2%. Absolutely, I think it's possible over the next few days, especially if we see the PCE this Thursday. We'll see, and maybe some month-end flows rebalancing. I don't know. Similar kind of situation with NASDAQ. We all know the situation with the Magnificent Seven or the Magnificent Six, NVIDIA. But again, just thinking maybe a little pullback here, maybe to like 16, where's the levels I had here? About almost like 17,000-ish. Maybe something down here could be, an attractive entry level, if nothing else. I mean, that's 4%. And again, not saying that I believe the equities are going to collapse into, 20%, but, a little 2, 3, 4% sell-off, I think would represent a very attractive level. And let's say on the NDX, the cash level would be something around about 16,950. I think would be a great opportunity to go long. Apart from anything else. So that's it for the equities. Now, just looking at a couple of other things here, just want to look at the US dollar. It's hard to, where are we? Hold on, just where is the US dollar? Now, at this point, we can see the US dollar, again, has been coming off a little bit, but it's hard for me to see the US dollar really collapsing, at least for the next 2 or 3, 4 weeks. I think there are significant risk events to the upside of the US dollar. And it's not so much that we want to actively be buying the US dollar. It's simply the fact that, are there any other central banks which are going to be more hawkish or hiking interest rates compared to the US? Now, we do have the New Zealand bank tomorrow evening. There's some talk that with extra immigration, they might be a bit hawkish, but at the end of the day, obviously, New Zealand dollar is not going to move globally, the US dollar. So I think at this point, there is a risk of the US dollar, possibly retesting these levels there. That would mean in the euro, if we go on to the euro chart, which I think I put here somewhere as well. Just give me a second, guys. Something like just probably trading in a range for the next few weeks, but, maybe in trading in the range of like 107, 107 up to maybe, 109, this kind of range here. And then, of course, it's all going to depend on those risk events. But if we do see some hawkishness out of the Fed and we continue to see strongish US inflation numbers and a strong US economy, I think if the euro gets up towards this this kind of level up here, which is about 109-ish, that would definitely be a great sell for the euro. Also based on the fact that I think medium-term macro for the Eurozone is less supportive than the US. So that's that. Just in terms of Japan, pretty interesting. I know some of us are watching what's happening over in Japan. If we look at the USD JPY, there's a bit of a risk event this evening. We have the CPI numbers coming out of Japan at what time is that? 6:30 p.m. A lot of the previews I've read over the weekend are calling for a lower than expected number of 1.9%. Why is that interesting? Because we know that the BOJ has a target of 2%. And so the risk there is that will solidify the views that will, solidify the views that the BOJ is in no hurry to normalize rates. I mean, you can't make, a whole prognostication based on just one data point. But having said that, you've got to believe that if those CPI numbers do come in a little on the soft side, that could, it's a very attractive target there for the USD JPY, could push up a little bit more up there, certainly like USD versus JPY. In terms of the cross pairs, I mean, it's a tricky one there because you see here that the Euro JPY is getting towards a level, it looks to me as though might want to test up there a little bit. Let's say something like, for example, CAD JPY, that's kind of a bit more overextended than either USD JPY or Euro JPY. We've seen that oil is trading a little heavy. We've also seen that Canadian data has been a little bit soft. So I'm not sure. I think there's more of a case for USD and Euro outperformance versus the JPY compared to, let's say, something like CAD or Aussie JPY. So we'll see. But I think definitely the first clue for that is the CPI data coming out of Japan. In terms of a couple of other things to be looking at, yeah, the other thing as well, guys, just talking about China and getting back to the FXI, the China equities market. We do have on Thursday, which I think is going to determine the next point. I showed you earlier on the FXI ETF for China. On Thursday evening, our time, we have at 8:30 and 8:45, we have the official PMIs, manufacturing PMIs from the NBS, the National Bureau of Statistics. We also have the private survey, which is the Caixin. I think it's going to be interesting because there's been a little bit of positivity about China recently. And so I just think the next move for that, I just showed you this chart here of the FXI. If that's to push upwards, I mean, if those Chinese PMIs are strong this Thursday evening, I think we could have a further push up. On the other hand, if they're weak or lower than expected, that could be just an opportunity for profit taking and down there. So that's just something in the China space. Finally, just want to have a look at oil here because I've been looking at that quite carefully. Oil's a tricky one. As you guys can see here on the daily chart, this is CL1. What's the good news in oil? The good news is that the physical market seems to be relatively tight. The calendar spreads, the inventories are sort of relatively supportive. We know that the Saudis and the Russians are trying to sort of cap supply. We have the next OPEC meeting coming up in a few weeks, I think early April. So at the moment, I think it's just stuck in a range because on the other hand, that's the good news. I was also reading something at the weekend that, after the Chinese Lunar New Year, people coming back from the holidays, there was quite a lot of buying by refineries of crude oil. So, there are a few sort of semi-positive little vibrations happening in the global oil market. On the other hand, there's also a feeling that, at the end of the day, the only reason the Saudis are cutting supplies is because there's not the demand. And the market is not stupid. The oil market knows that the Saudis, for example, have an excess capacity, production capacity of about 3 million barrels a day. So it's not really that there's a shortage of oil. There's actually a glut and surplus of oil, and it's just being artificially suppressed. And so it's not really structurally that supportive. And so that's why the market, I think, is a bit reluctant to really push this price higher. Having said that, from a technical perspective, kind of just consolidating in like a multi-week or like a 2-week kind of range here. I don't know really what to say. Personally, I'd be interested in going long, but only if the breakout is confirmed. It would have to, like, essentially at this point, it's been rejected, you could say, sort of 4 times, quadruple tops. Often quadruple tops, they don't hold. So for sure, if it gets up here, I mean, I think, and it's confirmed, there could be an interesting little trade there. But on the other hand, just on a very short term, what I'll be looking for, I'm going to throw this on a 4-hour chart. This is my way of looking at this. Just give me a second here. I'd be looking at a fib, and we want to see, like, the oil market has to pass a few tests. And I have to say that's not bad. So at this point, it has passed the first test that at the 38% fib on the 4-hour chart, it was bought. That's interesting. That's showing a little, bit of buyer interest there. So I think the next point pretty simply is that we have to get above these recent highs. And then it has to break through there. I think until and unless the oil market can definitively show that it's broken through, by which I don't mean getting to this level and testing higher and coming back. I mean, it must go through this level, maybe retest lower, and then go. I think it's only at that point that we can say that this chart is definitively is bullish. And of course, the shorter term way is to say, well, okay, that's good. But just on a very day trading kind of perspective, you could throw a smaller fib and say, hey, at this point, to have a bit more bullish, it needs to at least get above this level. So we're just waiting for that. Nothing to say at the moment on oil. And then finally, guys, just want to have a quick look at gold. Again, gold, we know this is structural buying by central banks around the world, which I think is supporting the market. But at this point, it's just ranging. It's kind of, how can we say, kind of muddling along, so to speak. Let me just get rid of this. Boom. At this point, again, a little bit like the oil chart, it was kind of, I think gold is just going to be trading between, I don't know, maybe like, hold on, that's oil again. Sorry, I said it's like the oil chart. That's because it is the oil chart. Cretino, let me go to gold. Where is gold? There's gold. Yeah. That's more like it. Okay, so as you guys can see here, just sort of trading here, probably between the levels of, I would say something like about, I don't know, maybe, 1990, 2000, this level, and maybe up towards 2080. Pretty simply, it's trading. Maybe the idea here is, any extremes would be a good sell up here at 2080. At 1990, 2000 would be a good buy. But again, this is going to be dependent on the strength of the dollar and of course, monetary policy. So that's where we're at. So just to pull that all together, I think we just have to get through the risk events over the next 3 or 4 weeks. That's going to provide some volatility, but I think that will not fully be. And so what's happened is that will not be fully, how can I say, realized until we actually get the Fed meeting. Because really what the market wants to know for the big next move is like, okay, is the Fed very worried about the CPI? Is the Fed very worried about the strong economic data? And will this narrative of the Fed that we're slowly coming down to the inflation target, will they actually structurally sort of change that? And the way that they will signal that is probably going to be at the dot plot. So at the and so what I'm trying to say is that the market has gone with that narrative and has hawkishly repriced a lot of assets since January the 12th. But really what we need to know for the medium term is what the Fed thinks. And we will not have that information until March the 19th. We will get clues leading up to that with the data, with the CPI, PCE, and et cetera, et cetera. We also have Powell speaking to in front of the two houses, the Senate. I think, when is that? I'm not quite sure, but before the FOMC. So if he does want to sort of hawkishly reprice the dots, that may be a clue there, but we don't have that. We won't have that for another few weeks. So I think at the moment, just be looking and just seeing. It's going to be super interesting to see whether the equity market just decides to have a little bit of a breather. It's technically very, very overbought, overextended. Maybe it wants to have a breather. It'd be interesting to see whether that's the case. Maybe it just wants to muddle along. And secondly, I think for bonds, they probably just will trade in a range. I don't think bonds will particularly rally, but I can't really see them selling off massively because they've already built in a lot of hawkishness over the last 3 or 4 weeks or so. So I'll leave it there. Let's keep on talking, and that's it for this week. Thank you.